How does the income statement connect to the balance sheet? In this video, I explain how the retained earnings account links the two financial statements together and show how common business events and transactions impact both the balance sheet and the income statement. I want to start by highlighting that it is very useful to think about balance sheet accounts as having a flow. They have a beginning balance, which is always carried over from the ending balance of last period. They have some events that increase their balance, some events that decrease their balance during the period, and that gets us to the ending balance. Now, those events that increase or decrease the balance could be economic events not aligned with the timing of the cash, or they could be cash transactions. So, for example, let's think about a couple of balance sheet accounts, an asset and a liability. When you start a period with a salaries payable, that starting balance reflects the work that the workers have done for you in the prior period that you haven't yet paid. So, you have an outstanding debt to your workers. Now, what happens during the period? Workers do more work. So, you have a salary expense on the income statement, and any salary expense leads to an increase in the obligation to pay those workers. However, you do also make periodic cash payments to the workers. And anytime that you make a cash payment to the worker, that decreases your liability to have to pay them in the future. And that gets us to the ending balance. So there's no other magical events that impact the salaries payable. It's only the salary expense that reflects the work that the workers actually do for you during the period, minus the cash payment to those workers. What about an asset? Let's talk about inventory. So when you have inventory at the beginning of the year, that is going to equal to your ending balance as of the end of the prior year. That reflects what you actually have in terms of the inventory available to be sold. Now, what increases the asset inventory? The purchase of inventory. So anytime during the year that you purchase inventory, and here I have it green as a cash transaction, but even if you don't pay for it immediately and you owe to the vendors, again, that purchase of inventory would increase the inventory account. What decreases the inventory account? The cost of goods sold, which is an income statement item that reflects the inventory that is sold during the period. What is the cost of it that is reduced from the asset inventory? And that gets us to the ending inventory at the end of the year. And we can apply this thinking to any asset or any liability or any equity account in terms of having a beginning balance, having some changes, and having an ending balance. Let's talk about a specific account that's going to be very useful for us to link the balance sheet and the income statement. On the income statement, we have the revenues and gains for this period only, minus the expenses and losses for this period only equals to the net earnings. Now, where does that profit go? In the first series of video, I introduced the retained earnings account, and I said that it represents the accumulation of all of the net profits that the company had in its history, minus all of the dividends that it declared in its history. So that works on a given period basis. We start the period with the beginning balance of retained earnings. Any profit that we have in the period is going to increase our retained earnings account. Any dividends that we declare in the period is going to reduce our retained earnings account, and that gets us to the ending balance of the retained earnings. One thing I want to highlight is a very, very common mistake. I hear the phrase dividend expense all too often. Dividends are not an expense. Dividends do not show up on the income statement. They do not represent a cost of running your business. They represent a choice by the company owners to withdraw some of the profit that they had during the period via the dividends. That's why we don't see dividends on the income statement, but we do see dividends reducing the retained earnings for the period. Let's illustrate an actual company. So this is a company, Hawkins. I had to pick it because I like Stranger Things. For the latest fiscal year, we have the consolidated statement of income. They had sales minus expenses. At the end of the day, they had net income of $84 million. This is a smaller company, so they're in thousands. Elsewhere in the financial statements, I see that they have cash dividends declared and paid, $14.6 million. And on the balance sheet, we see that their retained earnings went from 364 to 434. So can we tie out the change in retained earnings exactly to their profitability and the dividends? Yes, we can. Retained earnings started at 364. They went up with net income, they decreased with dividends, and that explains exactly how they ended up at $434 million. This linkage of the balance sheet and the income statement through the retained earnings account is going to be very useful for us to illustrate our mode of recording financial transactions, keeping an eye on how they ultimately impact the financial statement. Let's refresh our memory from the last video. What are the three questions we ask ourselves when we think about economic events? Which accounts did this event affect? Did the accounts go up or go down? And by how much? Now, again, a reminder that we always have at least two accounts that are impacted. On the prior video, we only saw transactions that impacted the balance sheet. In this video, we're going to see transactions that impact both the balance sheet and the income statement. Let's start from a very simple hypothetical example that I showed you in the prior videos that said, let's imagine a simple world where we have no disconnect between the economic event and the cash payment. So we have a cleaning service that sends a housekeeper to residents, collects $100 from the customer immediately, and also remits the $60 to the worker immediately. What do we record in this situation? Well, let's always start by asking ourselves, what's the impact on the income statement? So for the sales piece, did we do our job? Do we get to record revenue? Yes, we did. We did our job. We have recognition of sales for $100. Now, on the income statement, our equation is revenues minus expenses equals profit. So we're going to put the sales under the revenue column because the sales account is the one that increased. And we're also going to fill in the profit column. This is not a separate account. This is just a calculation in terms of how did the sales actually impact our profitability. Our profitability went up by $100. Now, very importantly, the next step is going to be somewhat mechanical. Anytime we have something impacting the profit column, we can think of that exact thing is also impacting the retained earnings. Why? Because we just saw in the prior slide, anything that happens on the income statement impacts the retained earnings. Any profit increasing transaction increases the retained earnings. Any profit decreasing transaction decreases the retained earnings. So in this example, we have the retained earnings that are going up by $100. And of course, we also collected the cash. So cash is also going up by $100. Our balance sheet is in balance, so everything is fine. Now, what about the $60? The worker did the work for us. So that is an expense that we're going to recognize as a salary expense on the income statement. That is a profit decreasing transaction. Because it decreases our profits, it also decreases our retained earnings. Again, this is kind of a mechanical step. Anything that decreases the earnings here decreases the retained earnings on the balance sheet. And of course, this one was immediately remitted in cash. So we have cash going down as well. Just as a reminder, when we think about the impact of the transactions in this fashion, we're not showing running balances of any given account. We're showing how a transaction ultimately will show up in the financial statements for this period. Let's continue our Hartford hot sauce example. What happened to Hartford hot sauce after they were formed during the first quarter? Let's suppose they rent a warehouse for $8,000. The company also employs a part-time support staff for $2,000. And let's keep it simple for now. Let's assume that the $8,000 and the $2,000 are paid in cash immediately at the same time. So this is going to be very similar to the transaction we just saw on the prior slide. We have a rent expense. Why? Because this is not a future benefit that we're paying for. We're immediately consuming the benefit. We're renting the warehouse and we're occupying it at the same time. So it shows up as an expense on the income statement, $8,000. That decreases our profit. That, of course, decreases the retained earnings equity account mechanically, and we have cash going down as well. Same thing with a salary expense, very similar dynamic. Let's call both of those selling, general, and administrative, kind of as a general umbrella, but I could have called them separate: rent expense, salary expense, that's fine. Reduces the profit, reduces the retained earnings, reduces the cash. Now let's talk about the sales side. If you remember, we had a customer who prepaid $6,000 but is waiting for inventory. Now we actually do deliver the inventory. So we did not get to recognize the revenue just when the customer made the payment because we need to make sure we do the work for the revenue to be recognizable. We actually do the work now. We get to recognize the sales of $6,000. That increases the earnings. That increases the retained earnings. Now we're not getting cash. Why? Because we have already recorded the receipt of cash from the customer during the prior period. So what's happening now is that At the time where a customer paid us, but we didn't do the work, we created a liability called deferred revenue. Now we satisfy this liability. We owed the customer something. We have now delivered it. So we get to reduce this liability. So deferred revenue goes down. So we have no changes to the assets. Is our balance sheet still in balance? Absolutely, because we have the equity account retained earnings going up due to the recognition of sales. We have the liability account deferred revenue going down. Everything is in balance. What about the inventory part? We have now delivered inventory that originally cost the company $4,000. So our cost of goods sold is going to be correspondingly $4,000. Profit goes down, retained earnings goes down, and inventory goes down as well. So we have handed over a piece of our asset. That asset was on our books for $4,000. Now it gets reflected as an expense in the income statement. Could I have lumped these two transactions together and just showed an impact onto profit of $2,000? Yes, but I actually like keeping them separately because it really illustrates that a sales transaction is comprised of two pieces. It's comprised of the recognition of revenue and the associated recognition of expense. Let's say they have more sales. In November, they sell and deliver inventory for $18,000. This was not prepaid. Instead, they get half of the payment in cash immediately, and the other half is on credit, meaning that the customer promises to pay us in the future. The inventory cost originally was $13,000. Do we get to recognize sale? Yes. Do we get to recognize sale for the full $18,000? Even though the customer hasn't paid us yet? Also, yes. Remember, it doesn't matter whether the cash exchange happened previously, at the same time, or in the future. The big question is, when is the timing of the economic transaction? For revenue, we get to recognize revenue when we do the job. That's at this point in time. So we have sales going up 18,000. That's a profit increasing transaction. That increases the retained earnings on the balance sheet. And on the asset side, we had cash going up for half of it, $9,000, and account receivable going up for $9,000 as well. What about the cost of goods sold? It's recognized in the same manner as on the prior slide. Cost of goods sold of $13,000. That reflects an asset inventory going down. And of course, profit decreasing, so a reduction in retained earnings as well. Notice that our rules are always followed. Every transaction impacts at least two accounts, but sometimes more. The balance sheet always remains in balance. And sometimes you have transactions that impact just the balance sheet. And here we see transactions that impact both the income statement accounts and the balance sheet accounts. Next, in November, the company pays off $30,000 it owes to inventory suppliers. If you recall, the inventory they received was on credit. So now they have a debt outstanding. They pay it off. Does anything happen on the income statement? No. Well, when do we recognize the expense associated with this inventory? We just did it on the prior slide. As we sell the inventory, we recognized its expense. But at this point, this transaction is just cleaning up of the debt. We had an accounts payable outstanding. We paid it off. Cash goes down. Accounts payable goes down. Again, just as a reminder, the way that we think about every transaction is how does this transaction ultimately impact the financial statements of this period? Hartford Hot Sauce employs a consultant to do some market research. Let's call this market research expense. The consultant does the job in December, but does not get paid until January. Do we record an expense for this quarter? Yes, if the consultant did the job for us, it doesn't matter that we haven't paid them. We have a market research expense of $5,000. That decreases the profit. That decreases the retained earnings. We do not drain the cash yet. Instead, we have some kind of an accrued expense. We could have called this consultant payable, but I want to use the word accrued as a reminder, as a throwback to the last video in the introductory series, that accrued means that the income statement recognition has preceded the cash outflow. So here we have a liability that reflects that we are going to have to pay them in the future. So for the last transaction, let's have a little fun with it, something different. Let's suppose the founders have a hot sauce recipe that their grandma has gifted them. Now, this is not a recipe that they developed. It's not a recipe that they purchased. So we don't have this recipe showing up on the balance sheet. It's currently having a zero value, but they managed to sell it for $20,000. Is this transaction going to show up on the income statement? Yes, but it is very important that we are not able to classify this $20,000 as revenues. Why? Because this company is not in the business of developing and selling recipes. They're in the business of selling hot sauce. So the sale of a recipe is a peripheral, it's an incidental transaction. It is going to show up on the income statement, but I'm going to put it in the revenue column just because I don't have space, but I want to be very clear. It's actually a gain account, a gain on sale of a recipe that goes up by $20,000. Profit increasing transaction means that our retained earnings account goes up. And in this example, there's no asset that they're removing from the balance sheet. It's just cash that's coming in for $20,000. We can pull all of the transactions that we covered in the prior video and in this video in a baby income statement. So Hartford Hot Sauce now has some revenues. They have some expenses, cost of goods sold, SG&A expense. That included the rent and workers, market research expense. They are not making profit. They have an operating loss right now. So I'm showing that as a negative number. But they do have a one-time non-recurring incidental item, gain from a sale, $20,000. So as a result, they have a net income of $12,000. That's how much the retained earnings should increase. So if we build out a baby balance sheet, then the retained earnings is in fact $12,000. So again, all I did is I pulled all of these transactions together, and every transaction we thought of it as impacting a certain account. Now, if we actually add them all up and we create a current ending balance of the accounts, this is what we would see. They have some assets, they have some liabilities, they have some equity. And we will notice that we recorded everything correctly. We can see that because the total assets actually equals to the total equity and liability. Now, I want to highlight that these are not the financial statements that are yet ready to see the light of day. So these are the financial statements that reflected all of the transactions that we have covered. But before this company is able to generate their final financial statements, they need to adjust for the passage of time. So there's other things that happened during the quarter that were a little bit more subtle, but also needs to be included in the financial statements before we're ready to finish our quarter. And that's what we're going to cover in the next two videos. Thank you for joining me in the second video of a series that helps us to structure our thinking to go from economic transactions to financial statements. If you enjoyed the video, then please like, subscribe, and share it with your colleagues and friends. I'll see you in the next one.